Let me tell you what happened this weekend while everyone was screaming Black Monday. A full-scale war broke out in the Middle East. One of the most important market makers in crypto, Jane Street, was sued and effectively removed from the equation. Crypto Twitter descended into doomsday threads, collapse charts, and countdowns to zero. The fear and greed index hit 8, not 20, not 15, 8. A reading of extreme fear that most analysts associate with genuine market panic. And here is what the market actually did. Bitcoin held a higher low. XRP held its support at 134. The S&P 500 futures were down roughly 1% going into Monday's open. 1%. On a weekend when a literal war broke out. And then the S&P didn't just recover, it erased all of its losses and closed green on the daily. I need you to stop and think about the weight of what I just described, because most people heard those same facts and felt fear. The people who understand market structure heard those same facts and felt something completely different. They felt confirmation. Because that is not what a dead market does. That is not what a market looks like when institutional money is leaving. That is precisely, specifically, mechanically what a market looks like when patient capital has already decided where the bottom is. And it is nowhere near where the crowd was screaming. Welcome back. I'm the Calm Analyst. Today we decode what actually happened in the last 72 hours, what the structure is telling us underneath the noise, and why the people who sold into the panic may have made one of the most expensive emotional decisions of this entire cycle. Let's go. Let's start with the hard truth that separates the crowd from the people who actually build wealth in markets. 90% of the people reacting to this market over the weekend were reacting to headlines. And there is a monumental difference between reacting to headlines and reading structure. Headlines create emotion. Structure creates wealth. They are not the same information. They do not lead to the same decisions. Here is what structure reading actually looks like in practice. When a major geopolitical event breaks, the first thing sophisticated market participants do is not sell in panic. They study the reaction. Because the reaction to news tells you infinitely more than the news itself. The news is the input. The market's response to the news is the data. And what did this market's response tell us? Bitcoin held $65,600. That is not a random number. Go back to October 2024. That exact level was the wick low before the rally that took Bitcoin to all-time highs. The market has memory. Smart money has memory. Price levels where major institutional programs were executed do not get forgotten. They become reference points, levels where the same participants who executed those programs are prepared to execute again. Instead of collapsing through that level under the weight of a war plus a market maker lawsuit plus extreme fear readings, Bitcoin printed a higher low. And then, within a 24-hour window, it constructed a higher high. That sequence, higher low followed by higher high, is the mechanical definition of bullish structure. It does not matter what the headlines say. The structure says something different. And structure is what moves price over time. XRP sat right above 134 support, tightening into a compression on the 24-hour time frame through all of it. War, market maker removed, fear index at 8, weekend liquidity at its lowest, and XRP held. That is not a weak asset. That is a resilient asset being accumulated while the crowd is looking the wrong direction. Now let's do the math that the crowd completely ignored while they were posting collapse charts on social media. The fear and greed index hit 8 last week. Today it has recovered to 20, moving from extreme fear back toward just fear. That is a jump of 150% in the sentiment reading within a matter of days. Here is why that number matters mathematically. Historically, and I want you to verify this yourself, every time the fear and greed index has moved from extreme fear back through the 20 to 30 range on a macro recovery, risk on assets have staged meaningful rallies within 30 to 60 days. Not every single time, but with enough consistency that the pattern is structurally significant. Extreme fear followed by recovery and sentiment is not a coincidence. It is the mechanical footprint of accumulation, of patient capital buying into retail panic at levels that retail is too frightened to hold. Now zoom out to the macro liquidity picture. There is currently $7 trillion sitting in money market funds in the United States. 7 trillion, not billion, trillion. Capital that is actively seeking higher yield in a rate environment where the Federal Reserve is navigating toward cuts. When rates fall, money market fund returns fall. That capital does not sit in a declining yield vehicle indefinitely. It migrates toward risk-on assets in search of the returns it can no longer get from cash equivalents. The total crypto market cap at its recent peak was approximately $2.4 trillion. That is roughly 1/3 of what is sitting idle in money market funds alone. You do not need all $7 trillion to move. You do not need half of it. You need a reallocation of 5 to 10% of that capital toward risk-on assets. And the math of what that does to crypto market caps becomes staggering. 5% of $7 trillion is $350 billion. That is more than the entire XRP market cap at peak. 10% is $700 billion, more than the entire crypto market cap at several points in recent history. And that money would not distribute evenly. It would concentrate in assets with the strongest institutional infrastructure, the clearest regulatory pathway, and the most credible use case for the capital that is doing the allocating. Which asset in the crypto space has the most institutional infrastructure, the clearest regulatory pathway, the most credible use case for the kind of money that currently sits in treasury management vehicles? The pipeline is built. The water is building pressure. XRP is one of the primary pipes. Now let me walk through the institutional behavior signals that confirm patient capital is already positioned, because this is the part that most retail analysis completely misses. Monday morning, war has broken out over the weekend. Jane Street has been sued and removed as a market maker. Fear index is at 8. Every retail investor in the world is checking their portfolio and feeling sick. S&P 500 futures opened down 1%. 1% on a weekend when a literal war started. If institutional money, the money that actually moves index prices, was genuinely frightened, those futures would have been down 4, 5, 6%. The measured, contained reaction in the futures market was itself the signal. The participants who actually moved price had already decided this event was manageable. They had already done the analysis. They had already determined their response, and their response was not panic. And then, not gradually, not over days, the S&P erased all of its losses and closed green on the daily. That is not retail buying the dip. Retail investors do not have the collective firepower to turn an index green in a single session. That is institutional capital executing pre-planned buy programs at levels that were identified in advance as value. The levels were marked. The programs were ready. When the price arrived, the capital deployed. Ask yourself this brutal question. Does a firm like Franklin Templeton, a $1.5 trillion asset manager, allocate to XRP-related infrastructure without absolute conviction that the regulatory framework is solidifying? Absolutely not. Firms at that level do not gamble. They do not speculate on headlines. They position based on analysis that the retail market will not see for months. And they have been positioning. Does Fidelity, running live crypto allocation models right now, interpret a fear index reading of 8 as a sell signal? No, they interpret it mechanically. Extreme fear is historically where assets are mispriced to the downside relative to their long-term value. It is where the patient capital that studies structure rather than reacts to headlines finds its entry. The smart money is not scared. The smart money is quiet. And quiet is exactly what accumulation sounds like. Now let's build out the specific catalyst sequence I am watching for the next 60 to 90 days. Because structural analysis without a timeline is just theory. The first domino is oil stabilization. I am giving this a 1 to 2 week window from the current moment. Once crude oil consolidates within a range and stops making new highs from the geopolitical shock, bond markets will exhale. The fear premium built into yields from energy inflation concerns will begin to unwind. Dollar strength will moderate. And when dollar strength moderates, the liquidity cycle that has been building pressure behind risk-on assets gets a release valve. capital that was rotating into dollar-denominated safety assets begins looking for yield elsewhere. That is the macro condition that precedes risk-on recovery. The second domino is Bitcoin's technical confirmation. The level I am watching is $7,600 on a daily close basis. That level, if taken out cleanly, invalidates the bear thesis of sub $60,000 entirely. It flips the narrative industry-wide. And when the Bitcoin narrative flips, XRP moves with it, but potentially harder because XRP has been compressing at support during Bitcoin's recovery phase. Compressed assets that have held structure through extreme fear tend to release with more force when the compression resolves to the upside. The third domino is the Digital Asset Clarity Act. Every week that passes without catastrophic regulatory news is a week that institutions can continue their quiet positioning. When the Clarity Act reaches a meaningful legislative milestone and the White House engagement, the Senate Banking Committee progress, and the bipartisan support all suggest that milestone is closer than the current price reflects, the risk premium baked into XRP's valuation disappears. Not gradually, almost overnight. That is not a slow burn. That is a repricing event. The wait-and-see money becomes all-in money simultaneously. 3 dominoes: oil stabilization, Bitcoin confirmation, Clarity Act milestone. When those 3 events sequence through, the structural recovery that the patient capital has already positioned for becomes visible to the mainstream. And by the time it is visible to the mainstream, the accumulation phase is over. Let me talk about the supply picture, because this is the part of the XRP story that gets the least attention and may matter most. 100 billion XRP, fixed supply. That number will never change. No inflation, no new issuance, no quantitative easing on the XRP ledger. Of that 100 billion, approximately 55 to 57 billion are in circulation. The rest sits in Ripple's escrow, releasing at 1 billion per month, with the vast majority relocked. The net new supply coming to market is a fraction of what the headline escrow release number suggests. On-chain data tracked through CryptoQuant and exchange reserve flow metrics shows that XRP held on exchanges has been trending downward. Tokens moving off exchanges do not come back to market for a 10% profit when a custodian, a bank, a payment network, an institutional liquidity provider takes XRP into an on-demand liquidity corridor as working capital. That supply is not trading inventory. It is infrastructure. It is effectively removed from the speculative float. Here is the supply-demand arithmetic that the crowd is not running. As institutional adoption accelerates, as more ODL corridors go live, as more trade finance platforms deploy on the XRP ledger, as RLUSD generates more transaction fees, as wormhole interoperability creates XRP demand across 35 blockchains, the demand side pressure increases. Simultaneously, the tokens being absorbed into institutional working capital pools reduce the liquid supply available to the open market, increasing demand against decreasing liquid supply. Fixed total supply. This is not a prediction. This is arithmetic. The math runs in one direction, and the window during which that arithmetic has not yet fully resolved into price, the window that currently exists, is not permanent. I want to speak directly to the people who sold into the weekend panic. Not to criticize the decision, the emotional experience of that market environment was genuinely brutal, but to make sure you understand what you were actually selling. You were not selling in response to a change in XRP's fundamentals. Ripple did not slow its acquisition strategy. Brad Garlinghouse did not walk back his 100% commitment. The DTCC did not remove Hidden Road from its infrastructure. The MasterCard RLUSD pilot did not end. The White House roundtables did not stop. The Clarity Act did not fail. You were selling in response to headlines about events that the market already determined were manageable. Determined in real time by the participants with the most information and the most capital, whose conclusion was expressed in futures markets that opened down 1% and an S&P that closed green. The market told you what it thought. The structure told you what was happening beneath the surface. The supply data told you where the smart money was moving. And the crowd was looking at Twitter threads about Black Monday, Being early feels exactly like being wrong, right up until the moment it doesn't. And that moment arrives not when the headlines turn positive, but when the structure that has been building quietly under the fear becomes too large for the mainstream to ignore any longer. Here is everything I want you to take forward from today. Bitcoin held $65,600 through a war, a market maker lawsuit, and a fear index of 8. XRP held 134 support through the same conditions. The S&P opened down 1% on a war weekend and closed green. Institutional futures reaction was measured and contained. $7 trillion in money market funds is seeking yield in a rate-cutting environment. The total crypto market cap is approximately one-third of that number. 5% reallocation exceeds XRP's entire peak market cap. The fear and greed index has already begun recovering from extreme fear. Historically, recoveries from extreme fear to the 20 to 30 range precede significant risk-on rallies within 30 to 60 days. Oil stabilization, Bitcoin technical confirmation, and Clarity Act progress are the three specific dominoes I am watching in sequence. All three are active right now. XRP exchange reserves are declining. Institutional custody is absorbing working capital supply. Fixed supply plus declining liquid float plus multiplying demand vectors equals a supply-demand dynamic the current price does not reflect. Ripple acquired Hidden Road. Brad Garlinghouse reaffirmed 100% commitment. The institutional pipeline is not paused. It is accelerating. The market did not break this weekend. It held structure through one of the most fear-saturated environments of the past year. The crowd saw headlines and felt panic. The structure said something completely different. The signal is clear, but only for those who are actually looking. Comment signal below if you made it all the way to the end. That tells me who my real audience is. The people reading structure, not reacting to noise. Stay patient. Stay rational. The market refused to break. That tells you everything. We don't wait for the future. We plan for it.